Hello, everyone, and welcome to today's webinar, Nova Credit Cash Atlas, the next chapter for smart and inclusive underwriting. Before we get started, I would like to go over a few items so you know how to participate in today's event. You may have joined the presentation listening using your computer speaker system by default. If you'd prefer to join over the telephone, just select phone in the audio pane and the dial-in information will be displayed. You will have the opportunity to submit text questions to the presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We will address them at the end. I would now like to introduce Sarah Davies, Chief Data and Analytics Officer, Nova Credit, and Kirsten Nicassio, Project Manager, Nova Credit.
Thank you, Trudy, and thanks for the opportunity to meet with you all today to talk about Cash Atlas. We're really delighted that you decided to join this webinar. And let me share a little bit about what our goals are for this webinar before we actually jump in. What we're hoping today is to share some information and insights around a new approach to credit underwriting using Cash Atlas. And that at the end of this presentation, hopefully you'll have a sense that using Cash Atlas, you will know how to prudently expand your consumer universe. And I think as critically, you will not only see that Cash Atlas is both essential and inevitable for prudent credit risk management in the coming years, given what we're about to get into. So with that sort of as our goals, what are we going to do in terms of what's the flow here? I'm going to spend a little time giving you some lay of the land and some foundation. Kirsten will then take you through the Cash Atlas product. I'll come back in at that point and talk to you about the business impact and the credit risk insight associated with the product, so you see the power of it. And hopefully at the end of that, I'm going to make you an offer you can't refuse. So please stay tuned for that, and we'll go from there. So if you were working in credit risk analytics 10 to 15 years ago, you'll remember that we were in an unprecedented time of credit risk. We had products like subprime mortgages that were almost impossible to manage from a risk perspective. We had consumer behaviors that we'd never seen before in terms of loan defaults. And we had a fundamental deterioration in the data and the credit risk tools like credit scores that made it almost impossible to navigate that territory. As a result of that, both FICO and VantageScore actually ultimately redeveloped their scores. Well, I'm going to suggest to you that we're actually heading into a very similar time, and if not actually more complex than we had back then. Consider the fact that we've got the COVID, let's call it hangover, of a situation where we've got historic behaviors by consumers where they've either been able to use their stimulus checks to pay down debts at a rate higher than they normally would, or they were able to take advantage of payment deferrals and payment holidays with the credit bureaus and the banks. On top of that, you've got an environment where the marketplace is being fundamentally disrupted by the buy now, pay later product. These are products that actually the bureaus have yet to decide how to report that data into the bureaus. They don't know how to score that information. And yet we see consumers, maybe 1/3 of the US population using that data, using those products rather, and some of those consumers using as many as 4 of those products at a time, none of which is being represented and reflected in credit scores today. And all of that is existing in the context of looming signals of recession. So if there is in any shape or form an understanding of what credit risk analytics and underwriting looks like in the next few years, I'm not sure that too many people would even have that insight. But unlike the last recession, we are actually in a place where there is hope. And why is that important? Because for over 50 million consumers who actually can't even get into mainstream credit under conventional data and conventional scores, there is actually a new set of data that we're going to talk about today. These 50 million are what we call the credit excluded consumers. They simply don't use credit in conventional ways, and so there isn't fundamentally enough information for them to be scored with, to be accurately assessed. But on the horizon, and really in some ways a more imminent opportunity, is the idea of consumer permission data. Consumer permission data really is, I think, our chance to create a much stronger credit risk ecosystem for the US and in fact globally. And we're kind of at that tipping point in this sort of environment today where there's tremendous receptivity to this information, unlike 10 plus years ago when alternative data was sort of still pretty much being shunned. Today, we see 80% of consumers saying they're willing to share their data if it helps get better approval rates and better interest rates. Globally, we're seeing great receptivity to bank data, especially open banking. 49 countries have already instituted an open banking policy. And lenders here in the United States are incredibly receptive to engaging with alternative data. 74% are using alternative data in terms of mainstream lending underwriting, and 89% are using it to look at their credit excluded population. So by any measure and by any means, we're in a much different environment, and one that speaks very positively of being able to bring in new forms of data. For us at Nova Credit, we believe that that promise is bank data. Bank data in the form of our Cash Atlas product has tremendous potential, not only for mainstream underwriting, but also for credit excluded consumers. There's a tremendous depth of insight associated with bank data beyond what we even get in credit data. You can use the data both as an overlay to credit data or as a substitute to it. It provides not only the standard propensity or likelihood to pay, which credit data does, but it also adds another dimension of information. It adds that insight around affordability. So you can now begin to look at a consumer and say, does the consumer actually have enough money in their bank in order to be able to afford the loan? And then will they direct those funds sitting in their bank account to repaying a particular debt? So it's almost a 360-degree lens that you're finally starting to get by incorporating bank data into your underwriting process. The other really great perspective around this data is it's highly scalable. Over 96% of US consumers have a bank account. And we'll talk a little later on about how much data you need in that bank account to accurately score you. But it's fundamentally the most unique source of primary coverage we have in the United States. It's also very easy to integrate. API solutions are now abundant and well-honed and well-refined in order to be able to engage the consumer and ensure that they are able to link their information. And just as significantly, this data is available instantaneously. So unlike credit data, where you may need to be waiting for those 30-day lags in terms of banks having updated your reporting information, you get bank data as of yesterday. So incredibly powerful insight, up to the minute insight on how a consumer is behaving. So those are some of the highlights and strengths, I think, of the data. As I said, we're going to talk in more detail in a moment, but I'm going to hand you over now to Kirsten to talk more about the Cash Atlas product.
Thanks, Sarah. So what we've done is we've built a product that harnesses that power of bank data that Sarah just described. What we do is we take bank data that consumers permission, and we process raw transactions that represent inflows, balances, and outflows into income, debts, expenses, and assets. And what we do on top of that is provide calculated attributes, trended insights, and affordability ratios that you can use. And so what we're really looking at is how much does someone spend relative to how much they make? How much does someone incur recurring expenses? And so we'll speak about that in just a minute. But what's exciting about that is that we've proven that these metrics that we're providing, these attributes, are risk predictive, all in an FCRA compliant way, which means that you can decision off of the analytics that we're providing. How does this work? So the first thing that happens is a consumer permissions their data in a real-time flow. So what they do is they agree to terms saying that they are going to permission their data, they choose their bank, they accept a disclosure, and they log into their account. So what we're doing is going across multiple aggregators to make sure that we have as high coverage as possible. And after that's done, they get a confirmation that everything's been successfully completed. Now, there has been concerns about consumer permissioning, and for the most part, the industry gets about 50% conversion through this particular funnel, which is to say that only half of the people that are going into the consumer permissioning process actually link their data. What we've shown in one of our particular case studies is that we're getting 80% conversion through this funnel, which means that you can realize those attempts at universe expansion more seriously. Yeah. So what do we do with that bank data? We provide just over 1,000 attributes right now that are proven to predict risk. These cut across income, debts, expenses, and assets, and they effectively give you insight into how someone is managing their money. I'll take net income as a primary example. Verification of income is a huge use case for our product, and what we're doing is we're saying that not all transactions that are coming into your bank account are representative of income. People can go to an ATM, go out to dinner with a friend and have their friend Venmo them for dinner, but they can have someone hand them a $20 bill on the street. They can even find a 20 and end up at an ATM. And this is what shows up in a bank statement. And what that really means is just a lot of noise. So if someone's saying, well, how much do you really make? Not all of those inflows are truly signal. So we have our proprietary income model that separates that signal from that noise and will detect regular paychecks, for example, that can be determined as income. And we also layer on from that net income state and federal taxes so that we can predict a gross income as well. The thing that I'll say as well on the expenses front is we can actually model how much someone has committed to recurring expenses. And that has been shown to be risk predictive as well. So let's say someone has a mortgage and several credit cards. Those show up as recurring expenses because there's consistency in the dates, descriptions, and amounts of those expenses. And so we have models that determine what those expenses actually look like. So what are the challenges that would stop you from using bank data? The first is, how do you motivate consumers to share their data? Well, as we've shown, we have this consumer permissioning module that has extremely high conversion across multiple aggregators. How do you know what's truly income? We have an income model that separates signal from noise of those inflows. How do you navigate joint accounts? Let's say someone is married and they have an account with their spouse or partner. Well, we provide attributes on both the account level and at the consumer level, which means that we can flag joint accounts for you so that you can figure out how to handle it in your own lending model. And last, how do you avoid double counting expenses? One of the things that we've done to work on this problem is to extract transfers between accounts. So if I make a transfer between my checking and savings account, we won't double flag that as income or as an expense. The last question that you might ask is, how do I actually plug this in? So we've come up with a couple use cases that you might think of. One is in underwriting. So in the case of a near prime applicant, for example, you do a credit pull and they might fail your traditional underwriting model based on that simple credit pull. What you can do is put Cash Atlas immediately after this flow, after an initial approved decline decision. And then you can say, okay, this consumer is going to permission their data and we'll make another call as to whether or not they're loan worthy after they've given us their bank data, which saves the friction for you. So your existing lending model still works, but you've produced a new ability to lend to someone based on their ability to pay rather over their propensity to pay. So you're effectively layering on bank data on top of credit data to make a more informed decision. Similarly, I've sort of gone on about the income model, but people do use our product for verification of income use cases where they'd like to know how much someone makes in their flow, and this is a way of automating an income verification.
Thanks, Kirsten. So you've heard now how Cash Atlas works, and hopefully you've seen some of the key differentiators that we believe our solution holds that make it a very compelling product compared to other bank aggregation solutions, bank data aggregation solutions. I think for me, when I look at the power of this kind of data, you really have to bring it back into the language and space of credit risk. And so what we've got here is a couple of slides here that give you a sense of how the data works and also kind of its predictive insight, predictive power. So this is an example of a couple of Cash Atlas attributes for a prime consumer. And in some ways, the sort of the tagline here is not all prime consumers are prime consumers. So from a credit score perspective, you know, when you say somebody's prime, we sort of have this sort of homogeneous understanding of who that consumer is. But this cash data actually does give you that other lens that allows you to see that these consumers actually can be differentiated, and cash data is what works for you here. So if we were to look at this consumer here in terms of, let's call it the higher risk behavior. So this is the consumer up in that tiny little yellow section of the plane here, of this sort of 3D graphic. What you've got here is a consumer who, while scoring as a prime credit quality consumer, actually has very low monthly cash reserves. And they also have very low recurring expenses as well. And by the way, this is actual data on consumers, so this is not something we sort of manufactured. So if you think about this, what you're also looking for with this data is that it's intuitive and logical. And so what you're seeing here is that consumers who have low cash reserves are likely to have little ability to afford recurring expenses. Recurring expenses are essentially credit loans. And so, you know, these are the consumers who, while they are sort of barely making it, they may be able to roughly handle the loans they have on book right now, actually are really unable to financially commit to other loans or additional loans. So again, while this is a prime credit quality consumer, they are probably not a prime cash quality consumer, given what we're seeing in terms of their capacity to afford that extra loan. Conversely, if we were to look at a lower risk behavior, what you see is a consumer who has lots of cash reserves, so a lot of excess balance in their account each month, therefore a high capacity to afford additional payment, and therefore a high likelihood to commit to recurring expenses, in other words, credit loans like a mortgage, a vehicle, or other installment types of loans. And so even here, what you're seeing again is that capacity of cash data to tease out performance within a credit lens. And again, one of the important things here, I think, is that we see that this data is very intuitively logical, which is why we are able to sort of build FCRA structure around it. But it also gives you an additional lens beyond what credit data is actually giving you. Well, what does that mean in terms of, let's call it, our traditional metrics of performance? We took the Cash Atlas attributes and we integrated them and overlaid them with portfolios of consumers who were assigned to particular credit tiers. And the idea here was to use Cash Atlas attributes as an overlay to the credit score and determine how much incremental value we could get in terms of predictive power or predictive separation we could get using Cash Atlas. We measured the performance on the consumers with a typical 90-day past due measurement and essentially compared the performance of these consumers with only a credit score and then with score and attributes. And what you see here on this graphic on the right is that the results, I think, are incredibly strong and very, very compelling. Subprime and near prime consumers, we saw a 16 to 20% improvement in the bad capture rate. That's the number of consumers who are actually defaulting that are identified by the analytics and essentially assigned to the bottom decile of the population. So a very, very strong read, especially for near prime consumers who would otherwise have been declined just based on their credit score. KS statistics fall right in line with this as well. If we put KS statistics on the table, and that, as you know, that's a measurement of separation, goods from bads, we see results on the KS scale of 40% better than simply using only a credit score. So on any measurement, what you're getting is a very, very powerful improvement in your capacity to manage risk in your mainstream populations. But what about that credit excluded population, those consumers who literally don't have enough data or any data to fit within the mainstream credit system? As I mentioned at the beginning of the presentation, there's 50+ million consumers in that space. Well, the first thing we did is we wanted to understand how many of those consumers had sufficient bank account data in their accounts in order to be accurately risk assessed. And what we found was of that 50+ million consumers, 88% have enough information using our attributes to be able to be accurately scored. So again, when you think about trying to access that 50 million, consumers, there really is one solution, and that's bank data that can give you access to almost the entire population. And again, the predictive performance is incredibly powerful. And here we did a study where we looked at what happens when the consumer links all of their accounts to the the pool for us, or they link only their primary checking account. As Kirsten mentioned, this has been one of those sort of conundrums that people get concerned about. You know, what happens if the consumer only links one account and we don't have the full picture? Well, either result actually shows an incredibly compelling result. If a consumer links all of their accounts, all of their checking accounts and their savings accounts, we're able to identify 40% of the consumers who default and allocate them to the bottom 22 deciles of the overall population. But equally encouraging, I think, is if they choose to only assign just one account, their primary checking account, and we've got some intelligence built into Cash Atlas to recognize if the account is the primary checking, we're able to identify 36% of the defaulting accounts. So again, a very, very strong result that for a group of consumers who you have no credit data on, you finally have actually a solution to work with these consumers. So what if you're bringing all of that together? What does your strategy look like? Do you need an entire new technology layer to introduce this data? And the answer to that is no. We built a strategy using Cash Atlas attributes and pairing it with credit data. And we wanted to understand what was the overall impact in terms of the business to the portfolio P&L. And what you see here on this graphic again is a pretty compelling strategy where you've got a capacity to decline accounts with a bad rate to the decline population of 25%. So super high risk. Clearly, you wouldn't want them in your business. The auto approve rate is a bad rate of 300. That's the equivalent of a credit score of, I think, maybe 660 to 700. So very high quality type of portfolio here. And then there's room where you probably want to do a manual review and in that sort of second tier in the middle of that population. So, you know, again, here is a very straightforward strategy using simply a Cash Atlas attribute of income minus expense ratios and a credit score together, and you get a very compelling result. In terms of the bottom line impact to your P&L, you have the opportunity under this analysis with this particular portfolio where we saw losses reduce by 3 to 5% compared to what would be achieved if you were using only a credit score. And you have originations improved by 2.5 to 4.5%. So an expansion on your population as well as a higher credit quality population as well. So net, I think this is an incredibly exciting situation. And finally, what we're able to do is sort of bring you some insights of this information sort of in the credit risk language without actually having to create a whole new platform by which to use the product. So I promised you at the beginning of this presentation that I was going to make you an offer you can't refuse. And so here it is. We have been working with bank data for several years now, and we have built up a variety of portfolios of data that are able to be used for retro studies. We would love the opportunity to do a retro study for you on your business and on your portfolio. We've got a couple of different options to the way we can do that. If you are already dabbling or even seriously playing in consumer bank data and are willing to share a data set with us of your bank data, your credit data and performance, we will introduce Cash Atlas attributes to that information, develop a risk optimized strategy and measure the risk separation. We will give you a Cash Atlas report that will allow you to see the predictive performance of the tool, give you a sense of what the value and the benefits are, both from a statistical risk perspective, but also from a financial perspective, and share with you which of the attributes and underwriting strategy components really deliver the greatest value. So you don't need to go hunt and peck through the 1,000 attributes that we built. We can focus you in and target you to the right place to get value for your business. If you have not yet worked with bank data, but would like to understand what it might be able to deliver, we can work with you to develop what we call a proxy population, where we understand from you the, let's call it the core dynamics, behavioral dynamics of your population. We will build out that capability, that universe using our own internal data. And then we will again introduce Cash Atlas attributes and run a cash atlas analysis report. So you get, again, a read on what the opportunities are. So I very much hope that you will take advantage of both of those, one of those opportunities. We are excited about what we think this can bring, and we think that it's really, inevitable that we will all ultimately be using bank data in our processes for underwriting. I also think at this point in the economic system, we absolutely need to bring this data in very soon. So I'm going to stop here, and we'll take some questions. All right, let me see. I've got a few questions here. So let me pull these up. Thank you. So Kirsten, I have a question for you. Can you speak more about frictionless implementation and what that looks like and what the resources required are?
Sure. Frictionless implementation is quite easy. So the first thing, that module that we've shown on the screen is a JavaScript widget that you could drop into any web page. It's actually the first task we give our new engineers to do a dummy integration, and they do it in a couple hours. So that may not translate to your business, but I hope that means that the integration is as easy as 1, 2, 3. And so what basically happens is you put that widget into your flow. Then there will be then when the consumer permissions their data, it'll get sent to us, and then we'll compile attributes. When we're done compiling attributes, we'll send you a webhook, and then you basically just integrate with the results API, and all the attributes are in that one response.
Great, thank you. Got a question here. Can you analyze more than one bank account? And the answer to that is yes. We will. We ask the consumer to share as many accounts as they are willing to do so. Checking, savings, assets, liabilities. We will provide attribute results back at the individual account level and also at the overall level. So you get a multi-lens read on the consumer based on the number of accounts that they're sharing. Another question here, in Cash Atlas, do you get a score or set of attributes or both? Right now, it's a set of attributes. We are, as Kirsten mentioned, we've built over 1,000 attributes, probably looking by the end of the year to have built close to another 500. There is a score on our roadmap, but we think that it's sort of useful right now for us all to sort of get in at the ground level with the attributes. And for some institutions, they prefer to actually work with the attributes rather than a score. But there is a score in our roadmap, and it is coming down at some point. Kirsten, question for you on FCRA compliance. What does that mean? What does it look like?
Sure. So in the development of attributes, we don't use any personal identifiable info, or PII. I don't think I've ever actually said the full 3 words in a long time. And we also use no information related to protected classes. And so in the development of the attributes, we remain FCRA compliant. And those mean that you can actually use our adverse action statements having made a decision. When you provide adverse action statements based on each attribute, you can tailor your message as well. Sarah, do you have anything to add to that?
The only thing I would say, I think that's exactly right. We've designed the adverse action capability to really align with the way we understand disparate impact, ECOA, adverse action sort of requirements on the credit side. So we very much leveraged all of the infrastructure and knowledge there, and that's what you'll see on the credit side. A question about does this apply to business, small business lending, things like that? Not strictly, I would say, is the answer to that. The data works very much from a consumer lending perspective, to the extent that small businesses are single office home offices, and the consumer is the business owner, and it sort of is a sort of an integrated pool of information. Then certainly the data and the attributes would be relevant there. But I think, strictly speaking, it's more of a consumer lending product. What information do we need? There's a number of questions here about the retro. That's good. That's going to keep me busy and Kirsten busy, so that's good job security for us. Thank you, everybody. So what do we need from you? We need a representative sample of your consumers. If you have the bank data with them, so share the bank data and also their credit data and their credit performance 1 year later, ideally. And so obviously all of that would be anonymized when we receive it. What we would then do with that information is we would sort of structure it, make sure we understand it, work with you to ensure that it's fully transparent, and then run our validation process on top of it.
Maybe I'll just add that it can come from any aggregator that you'd like. So
Great point.
Finicity, Plaid, MX, Yodlee.
Yes, super important point. Super. Number of questions here about, is this for US banks only or European banks as well? Right now, we are building on the US aggregator base. We have partnerships in the international bank data partnerships, and so that's also on the roadmap, but I would say that's a next year direction rather than what we have targeted for this coming year. And finally, is the presentation available after the call? Yes, absolutely. We'll make that presentation available, and also this webinar will be available on the website. And then I'm seeing a number of questions about secondary accounts, checking accounts, all that kind of stuff. We are developing white papers around all of this to give you an understanding of what happens when a consumer links one account. You saw me reference that in the credit exclusion population, primary checking versus secondary accounts. What does that mean in terms of predictive insight? What does that mean in terms of incremental capacity to sort of score consumers and things like that? So those, I think, are all the principal questions here that I got, and I also noticed we are 5 minutes past time. So I think we should probably wrap up here. What I want to say is thank you so much for your joining the webinar. Hopefully you found some interesting and exciting data and insights here. Please don't hesitate to reach out to us with further questions. We have lots of deeper dive research and stuff that we'd be delighted to share with you through our team. So thanks again, everybody, and take care. Trudy, I'll hand it back to you.
Okay, thanks everyone for attending today's webinar, and feel free to have a good rest of your day. Thank you.